So we said that the cost volume profit analysis was also a decision-making technique. That is the break-even, knowing the number of quantities to produce so that the firm will not run at a loss for a single product and for a multi-product, that is two products. That is one aspect of decision-making technique. The next decision-making technique that we want to look at today is taking decisions under certain conditions. Now, the conditions can either be under a situation whereby you have a perfect information. Okay, so decision making where you have a perfect information is one of the decision that makes it certain. That means that you have all the relevant information. And so we say that you are certain about the information that you have. So assuming you want to buy a pen, and then previously you have experience in buying it. So you know that, okay, this is the price for a pen. This is the price for a pen from about 4 shops, 5 shops. And then you have full information about it. So you go ahead and you buy the pen. That is when you are so certain about the decision. Now, there can be a time whereby you can take a decision when you don't have the full information, but the partial information. A partial can be maybe half or more. So that is where probability comes in. So that is decision making with risk, where you have partial information and not the entire information about the item you want to purchase. Then other instances, you would have decision making under uncertainty. That is either there are no information about the item or the information about the item is minimal, a bit. That will help you to take that decision. So anytime you are faced with a decision to take or an alternative to select from which there are little information about that item, you fall under the criteria called the decision making under uncertainty. Decision making under uncertainty. Okay. So once we say decision making under uncertainty, there are 3 criteria to compute for decision making under uncertainty. The first criteria is the criteria of the optimism, that is being positive about the outcome. And so to do so, we use what we call the maximus criteria and the minimum criteria. When you are positive about an item, we use what we call the maximum criteria and the minimum criteria. Don't forget I told you that we use maximus criteria for anything profitable, anything with respect to profits, sales, or contribution. That is when you use what we call the maximus. But then we use the minimum criteria for anything in relation to cost or losses. So if you're making a loss, or if the table given you is a loss table or a cost table, and then you are asked to find the optimism or the positive criteria, they are telling you to do what we call the minimum. So just make sure you have read through the information, and once they state the optimism and all that, you know what we're talking about. And then when we come to the pessimism, it's something that has a negative output and a hybrid criteria, and that is the maximum criteria and the minimax criteria. So this would also have to do with profit and sales and contribution, and the minimax would also be looking at the cost or the losses, depending on the table given you. And the third criteria under decision making and uncertainty is what we call the minimax regret criteria. Now, this is different from all the things you need. So here you do what we call the regret table before you come and do the minimax table. There's a difference between this third criteria and the second criteria B. This has regret attached to it, and this is just the minimax. Now, the regret means that you first prepare a regret table, and after preparing the regret table, you come and prepare the minimax from the regret table. So, these are the three criteria that we'll be looking at. But then before we can do any of these things that we are talking about, we need to determine what we call the payoff table. Now, if you are fortunate, some questions will give you the payoffs. So what you find inside here as the figures are what we call the payoffs. And then in the payoffs, we use them to determine the payoff table. Now, the payoffs can be determined for you in the question. Other way around, they would ask you to determine the payoff yourself. And that is what I'm saying, that the payoff figures can either be a profit figure, a sales figure, or a contribution figure. So you can have sales being given you and then variable cost being given you. And then you are expected to use that to determine what? Contribution. So we'll be using the sales figure and the variable cost to determine the contribution for each of this. In another question, they just pose them for you. But then in other questions, you need to determine them yourself. So let's look at this example. Assuming the payoff has been determined for you. And then once the payoff is determined for you, you would see these two colored items. One is called decision option or alternative. That is the decision that is before you. Are you going to invest in stock? Are you going to invest in bond? Or are you going to invest in a mutual fund? That is what we call the decision alternative. And then when we come to the vertical, we call it the horizontal. So the vertical, we call it the market condition or the state of nature. But when you look at the horizontal, it's called the decision options or alternatives. So the market condition is telling you how the item is like. So the item must be in best condition, average condition, worst condition. The item can have 40% chance of losing or whatsoever that have you. So this is what we call the state of nature and then the decision option or alternatives that are presented before you. Now, when it's already fed with the items like this, and then the decision is horizontal, and then the state of nature is vertical, and then you are asked to determine the maximax criteria or the criteria of optimism. Assuming this is a profit table or a contribution table, once you are asked to look at the criteria of optimism, since you've had profit table, it means that you are going to do the maximax. And the word maximax can be divided into two. So it first means that the maximax, it means that determine the maximum values under each decision option, then out of it, select them highest. What do I mean? These are the decision options or decision alternatives that you have. First, select the maximum values under them. So the first one, you first tackle the one behind it, then subsequently you come and tackle the one before it. So under the decision option stock, we have 200, we have 250, we have 150. Which one is the highest or which one is maximum? The maximum is 250. Then under bond, which is a decision option, what is the maximum for them? The maximum is 450. Then under mutual funds, what is the highest? Is 160. Now, after determining this, the next is for you to select the second option, which is the maximum value of the maximums. So 250, 450, and 160, which one is the maximum? The 450 is the maximum. And it is which option? The bond. So you quickly say invest in bond. Any question? Any question? Okay. There are no questions. Let's continue. So that is for Maximax. Assuming it was a cost table, we'll be doing what we call the minimum. Do you agree? The minimum can also be divided into two. The minimum can also be divided into two, which means that we need to first select the minimum values, and out of the minimum values, we choose the minimum figure. Okay. So someone is asking us to go over. This topic is a bit confusing, so you need to pay attention. Now, I said that there are three criteria under the decision of uncertainty. Now, to be uncertain about the information that is readily available, you are likely to do three things. What we call the criteria of optimism, that is looking out for a positive output, and the criteria for pessimism, which is a negative output. And then we have the minimax regret criteria, which means that we'll prepare a regret table first before we come and prepare this. Now, under the positive, we are saying that there are two things here. We have what we call the maximax criteria and the minimum criteria. Now, those two criteria will be dependent on the question. So if the question is a profit sales contribution, we quickly use the maximax. That is for the payoff. So it is the payoff. If the question is a minimum, that is if it is cost and losses, then it means that we'll use the minimum to determine the optimism. If it is cost, we'll use the minimax under the negative. And then if it is profit, we'll use the maximum under the pessimism. Now, I'll teach you another name for all of these things when we are going forward. Because I think I asked in last week's class, but then most of you are not there. So I'll teach you another thing they can ask you. So the question can tell you to do the maximax. It can ask you to do the minimum. It can ask you to do the maximax, a maximum, minimax. But then the question can also tell you, find using the optimism, calculate your which of the investments you need to go in for. So when it says optimism, ask yourself, is the question a profit question or is it a cost question? Whichever one the question informs you, then it means that you'd use that. Now, there is another word for all of these things. We have what we call, when we get to such a question, I would explain to you. So I'm saying that assuming this is a payoff table, this is a payoff table that you have. And in this payoff table, there are two things you should look out for: state of nature and then decision options or alternative. The state of nature is the market condition of the items you want to select from. You see, so there'll be a presented items you must select from. There'll be some list of items you have to select from, which is the alternative. And then this list of items you need to select from are the options. Now, it is based on these options that you'll be using for the determining of first criteria and second criteria. So under the first criteria, if you ask me to look out for the maximax, and it's a if you ask me to look out for the optimism, and it is a profit payoff table, then it means that I must look out for maximax in that question, which is the maximum values. So out of 200, 250, 150, which one is the maximum value? The maximum
250.
value here will be 250. Under bond, what is the maximum value? 450. Because I said that maximax means we tackle the latter part, which is maxi, then we tackle the next option, which is maxi again. So we are looking for just maximum values. And out of the maximum values, we select the maximum number. So these were the maximum values under each decision option or alternative. So ask yourself, which one is the highest amongst all of these things, which is 450? Which decision option is that, or which decision alternative is that? Bond. So you advise that the firm should invest in bond. You have now taken a decision under the optimism. Now, the question says that assuming this payoff is a cost payoff and it is not a profit payoff, once it is a cost payoff, you do what we call the minimum. which means that under each decision option, select the minimum values. What are the minimum values? Let's go. The minimum value for stock is 150.
150.
The minimum for bond is 200. And the minimum for mutual fund is 50. We have determined minimum. This first before this one. So what is the minimum of the minimums?
Mutual fund.
Mutual fund, which is what? The 50. So 50 is the minimum of the minimum, which is mutual fund. Get it? This is just one criteria. And I'm saying that the criteria will be based on either the profit, the payoff table being a cost or profit. If the payoff is a profit, we'll use the maximax. Under the optimism. If it is cost, we use the minimum. Under the optimism. Okay. Now, this same table can represent a pessimism table. So assuming it's a pessimism table, and then they ask us to look out for maximum. The question is, what does this mean? Maximum. What does maximum means? It means that you need to first treat, or you need to look for the minimum values. Out of the minimum values, we select the maximum figure. Okay, what do I mean by this? We are doing what we call the maximum under the pessimism. The maximum. Always divide this into two. This should come first, followed by this option. So, out of the decision option, select the minimum values. After you selected the minimum values, you select the highest of the minimum values. So what is the minimum of this? 150. What's the minimum of this? 200. What is the minimum of this? 50. After selecting the minimum values, it is requested that we select the maximum. 150, 250. Which one is the maximum? This one is the maximum. Hence, we are going to attribute it to what? Bond. So under the maximum again, bond happens to be the investment you are advising them to take. Is that clear? Are we fine? Okay, if you not talk, we'll continue. Okay, now in the same pessimism, if it is cost, we'll be doing what we call minimax, which means that we need to select what first? We need to select the maximum values first before we come and select the minimum of the maximum value. So let us look at it. Minimax. Minimax. This comes first, followed by this. So quickly, we'll look out for the maximum values under each decision option. Decision option, stop. The maximum is 250. Decision option, bond. The maximum is 450. Decision option, mutual fund, maximum is 160. And the thing is mini max. So after selecting the maximum value, which one is the minimum? The minimum still stands at what? 160, which is what? Mutual funds. So these are the two very easy criteria that we need to first tackle. These are the two easy criteria we need to first tackle before we decide on looking at the next option. If you have a question on determining these two, easy one, then I think I should pick my bag and go home and go and sleep. But if it is clear, then let's look at the next option, which is called the minimax regret criteria. Out of this payoff, please pay attention. Let me use this payoff here. It's the same payoff. Now, out of these payoffs, this is what the minimax regret. I've told you that is different. So minimax regret criteria. This is how it happens. Now, how does it happen? It happens by first constructing what we call a regret table. Now, how is this regret table constructed? For the regret table, you not stand on the decision options again. You will now be looking at it from the angle of the market conditions. The market conditions. So we are going to first construct the regret table looking at the market conditions. Now, you select the highest of the market condition, meaning that you could have done 300, okay, under the best condition. Under the average condition, you could do the highest, which is what? 250. And under the worst condition, you can do the one which is 450. Okay. Now, these are what we call the regrets. So you construct a table quickly using the regret table. What do I mean by that? Look at me. Okay. So it means that this is the regret table that I'm going to create. It means that if I'm unable to go in for the 300, I'll regret how many? Under the first table, if I'm unable to go for the 300, what would be my regret?
100.
100. If I'm able to go for the whole 300, what would be my regret?
Dash.
0, right?
Yeah.
If I'm also unable to go for the 300 and I decide to go in for 100, what would be my regret?
200.
200.
I'll be regretting 200. Same for the average conditions. What was the highest? 250. If I'm unable to go for 250, what would be my
Dash.
regret?
Dash.
Dash. That is 0. Now, if I'm unable to go for 250 and I go in for 200, what would be my regret?
50.
If I'm unable to go in for 250 and I go in for 50, what would be my regret?
200.
And if I'm unable to go, the next one, which is the worst condition, the highest was 450. If I'm unable to go in for the 450 and I decide
300.
to go in for 150, I'll be regretting 300.
300.
If I go in for the whole 450, what would be my regret?
0.
0. The next one, if I'm unable to go in for the whole 450 and I decide to go for 160, what would be my regret? 290.
0.
Are we correct?
Yeah.
Is that correct?
Yes.
All right. So this will be my regret, and this is what I'll use to construct the regret table. So this becomes my regret table. So quickly, I'll construct a regret table, which means that there will no longer be 200 here. The regrets would rather replace the payoffs and now become the new payoff. That is why we say that the regret first comes in. Once the regret comes in, before you now come in based on the minimax. Okay. So we first prepare that regret. Okay, so this becomes what we call the regrets table. The regrets table. Now, from this regrets table, we now have to follow the decision called the minimax. Okay. Now, the minimax will still go ahead with the vertical way of doing things. So you jump back again. It says what? Minimax. So which one will come first?
Maximum.
The maximum will come first, followed by the what? Minimum. On the regret table. Okay. So here, what is the maximum? 300. From here, what is the maximum?
50.
And then from here, the maximum is 290.
Okay.
What is the minimum of the maximums?
50.
And that is for what? Bond. So on the minimax regret table, we first prepare what we call a regret. And then to prepare the regret, you go according to the state of nature. One, the state of nature, and select their maximum values under each state of nature. So under state of nature best condition, we select the maximum value being 300. Under the state of nature called average condition, we select the maximum, which is 250. Under the average condition called, under the state of nature called worst condition, we select the maximum, which is what? The 450. Then we come and then prepare them lane by lane. That this has a value of 300. Assuming I don't select 300 and I go in for 200, I'll be regretting. And that is the difference. So if you look out for the maximum, it says that the maximum payoff that you select minus the payoff at that level. So the maximum payoff I selected, which was 300, minus the payoff at that level, which is 200. So you look at it here. The payoff at this level was 200. The maximum value selected at that level is 300. So the maximum value minus the payoff at that level will give me my regrets. Any question? This topic is not that easy like ABCD. This one, we are just even determining what we call the values without first determining payoff. There are some questions you need to do the payoffs yourself before you come and do this ones. See. Any question? All right. So I know and I believe there are no questions. So let's continue. Now, I'm going to show you a question. We are not done. After doing this one, we are just done with decisions under uncertainty. I have to teach you decisions under probability and risk. For this one, normally you are not examining on decision making with certain information. You want to buy an item, you have all the available options. You just put them together and get your answer. But the probability is what I told you the other time, that we'll be using what we call the expected monetary value or the expected value, the EMV or the EV. According to our slide, we saw that it was called the EVs. So if you read through the slides, you realize that risk has been defined, and this one says relevant, that is partial information. And then this one says little or no information about the item that we want to take a decision. So I said that with risk, we use the expected monetary value, knowing your probability and multiplying by the expected value. So these were the values. These were the profits we were looking for. These are their probability. Multiplying the probability by this and putting them together is what we call the expected monetary value. So it is question dependent that you know. Now, the risk or the expected monetary value is used. I told you that that one is used when we are talking about someone who is a risk neutral. Risk neutral, he is found between a risk lover or someone who does not love risk. So a risk lover or what? Another name for
Risk.
someone who risk averse. Okay. Risk averse. Adverse. Or is it averse? Averse. So someone who does not love risk is a risk averse. And someone who loves risk will be what? A risk lover. Now, I said for this one, we use the EMV, expected monetary value, or the expected value, EV. Now, under risk lover, what did I say we use for the risk lover? Risk lover, someone who loves risk. Yes, anyone attempting it? A risk lover? Hey, should I leave you here? A risk lover.
You have forgotten.
You have forgotten. Okay, a risk averse. Someone who does not love risk. Which of the criteria would fall for the one who does not love risk? Were you all in class, or before we decided to take it, you had left? So a risk averse person will use what we call the maximum. The maximum. And then someone who loves risk or a risk seeker will use either the maximax. We use the maximax. Someone who loves risk is positive. So if it is profits, you'll be using maximax. If it is cost or losses, the person will be using minimum.
Okay.
So a risk lover is the same as someone who is being optimism or optimistic. And then a risk averse is someone who is pessimistic. He doesn't love risk, so pessimism. Pessimism. So he doesn't love risk. And then when you look at the formula for someone who does not love risk, we said it was the what? Maximum or the what?
Minimax.
Minimax. Thank you. Please, you will not be told this in class. That is why I'm telling you everything here and I'm giving you everything down here. I know you will not be told this in class. And this will be something that you'll be struggling with because it is highly examinable. Why? Look at this question before us. One of your questions your seniors wrote. You see, the question was not straight. The only place it was straight was that if Shuffle Co adopt a minimax regret approach to decision making, here you know it is minimax regret, meaning that we first need to determine the regret before we come and determine the minimax. But look at something like this. If Shuffle Co is risk averse, which grade of track will it purchase? And we've got to know that the decisions options are the alternatives you have to select from. So the type of tracks are the alternatives you have to select from, and then the growth becomes the market conditions. So the market can either grow or the market can retard. So these are the state of nature, and these are the decision, what do you call it? Options or alternatives. Do you agree with me?
Yeah.
Are you sure you agree with me? Those who are quiet. This thing can lash you. If you don't open up, it will lash you. Okay. So let's read the question together and know what it's asking you to do. So once you read the question and it is a profit, then that means that when you say it's risk averse, it is the maximum you'll be using. But then if it is a loss question, then it means that you'll be doing the opposite, which is what? The minimax. So you say Shuffle Co, uses forklift trucks in its warehouse. The management accountant is deciding which grade of truck to buy based on the company's risk appetite. There are 3 grades of trucks: the A series, the B series, and then the C series. The decision for the truck is dependent on the Shuffle Co's growth in the online market, which could be 15%, 30%, and 40%. For the next period, the management accountant has correctly produced a payoff table showing the daily contributions. Please, this is contributions. So contributions, profit, and sales, I said we'll be using the what? The maximax and then the maximum. So for each of the following, that is the contribution. So this is the payoff table that has been constructed for you. Now the first question is that if Shuffle Co is a risk averse, which grade of truck will it purchase? Risk averse is someone who is pessimism. So if it is a risk averse person, then we'll be using which type of, or which of the formulas under the pessimism. We'll be using the maximum. So we'll first select the minimum values, after which we'll come and look for the maximum out of it. Okay, so let's go. Under A series, what is the maximum? What is the minimum? A series, what is the minimum?
1,004.
B series, what is the minimum?
1,008.
1,900. Minimum, 1,800.
1,008.
And then C
1,008.
series,
3,006.
3,600.
So 141836. Which one is the maximum?
36.
Are you sure? So which car or which truck of series would you advise Shuffle Co? C series.
C.
So
Yeah.
here we write the series. You don't write the figures. You don't write the payoff. You write the alternatives. Then let's go to, so I'm taking you from here. I'm taking you to an Excel sheet. I've replicated them here, which you can see them nicely. Okay. So the type of tracks is the decision. Yes. No. So the type of tracks, and this one was the market condition. So the growth. All right. Now, that was for the risk averse. So under the risk averse, we use what? Maximum. We use the maximum. Then, because it was a profit, it was a contribution function. Please get it, because it was a contribution table. That is how come we are using the maximum. If it was a cost, we'll be doing the minimax for the risk averse. So please take note of these things. Okay. Then let's go to the next person. The next question. It says risk lover, right? Or risk seeker. If Shuffle Co is seeking or is risk seeking, which grade of track? Which means we'll be using the maxi max. So the maxi max, let's go. 2,400, 1,400, 4,400. What is the maximum value? 4,900. Then under the B series, it is 2,800.
Good.
C series, 3,900, 4,500, sorry. So between 4,900, 2,800, and 4,500, please, which one do you think is what? 4,900, which is what? A what? Series.
Series.
So when you come here, you see it here. A series. Okay. Now the next question was asking us to do the regrets. Look at it carefully. It says, let's construct the minimax regret approach to the decision making. Which grade of track will it purchase? And I said that with this one, our focus will be on the market. So our focus will be market by market, selecting the best option. So let's go to this market condition, 15%. What is the best option?
3,600. Yeah.
Then when you come to the next market option, which one is the best? 4,500. When you come to the next one, which one is the best? 4,900. So we will use this to construct the regret table. So you and I agree that on the first lane it was 3,600. So if I don't go for 3,600 and I go in for 2,400, I'll be losing how much? 1,200, right? So that is what I have here at the regret table. So this is the regret table. If I don't go for the 3,600 and I go for 2,400, I'll be losing 1,200. If I don't go for 3,600 and I go for 1,800, I'll be losing what? Around 1,800 again. If I don't go for the 3,600 and I have 3,600, I'll be losing 0. Same here, 4,500 and I choose 1,400, I'll be losing somewhere around 3,100. And then if I do same for the next, I'll be losing somewhere around 3,600. And here I'll not lose any value. When I come to the 40%, the highest was 4,900. So if I go in for 4,900 and I have 4,900, I don't lose. If I select the next option, B series, if I select 2,800, leaving 4,900, I'll make a loss. So this is it. These were the figures. So I'll be making a loss. So this is the regret table. The 1,200, because 3,600 minus 2,400, the 1,800, the 0. The 3,100, the 2,600, the 0. The 4,900 minus 4,900, which is a 0. The 4,900 minus the 2,800, which was 2,100. And then the 4,900 minus the 3,900, which is a 1,000, has only given me what we call the regret table. I've only drawn the regret table. Now, from this regret table, I am supposed to do what we call the minimax. So, in minimax, the maximum comes first. Then you now select the lowest of the maximum. So, under A series, what is the maximum? 3,100. Under B series, what is the maximum? 2,600. And under C series, where we have 0, 0, 1,000, the maximum will be 1,000. Now, out of these maximums, we are supposed to select the minimum value because it is minimax. 3,100, 2,600, 1,000. The minimum will be what? 1,000. So which series is that? The C series. So quickly, under the maximum regret, the minimax regret approach, it is still going to be the C series. Please, this is not Luto. Don't go sit there and be writing anything that you know. You agree with me now?
Yeah.
Who is lost? Out of the 19 people, with myself inclusive, I would be the only person and Benjamin to understand this fully. The Akanina, I know you'll be lost.
They are still learning now.
They are still learning. Okay. So, ladies and gentlemen, this is a course you need to take serious. It dropped in the exams. Management accounting is a serious course. This is just the second topic you are treating out of the lot. We are going to do budgeting and standard costing, and then you realize that, Charlie, this course, we should have started earlier than expected. And when I call for class, you don't even delay my time. You come. Okay. Now, we are just done with just 3 out of the 4 questions or 5 questions that have been presented as. The next one says that if Shuffle Co is risk neutral, which grade of track will it purchase? Now, this is what you should know. We should have been given probability to multiply by each of these ones and add them up. But unfortunately or unfortunately, we are lucky. So when we pick the A series, we multiply them by the growth rate and add them up. When we pick the B series, we multiply them by the growth rate and then add them up. When we pick the C series, we multiply them by the growth rate and then add them up. When you are done, you compare the expected value for A, B, C, and then you advise the one with the highest expected value. Do you get it? So assuming I count for A series, under A series, 15% times 2,400. If there were probabilities, it is the probability figure you multiply by the figures under them. So A series, 2,400 multiplied by 15%, 30% multiplied by 1,400, 40% multiplied by 4,900. Then I write the total. That is the expected value. When we come to B series, 1,800 by 15%, 1,900 by 30%, 2,800 by 40%. Then I'll add them up. When I come to the C series, same, 3,600 by 15%, 4,500 by 30%, 3,900 by 40%. Then I'll add them up. Now I'll be presented with three totals, 1, 2, 3. I am expected to select the maximum of the expected value to be the track that I'll select. So look at it. So under A series, 15% times 2,400 plus the 30% times 1,400 plus 40% times 4,900 presents me 2,700 when I sum them up. When I go to B series and I multiply them by their probability, I get 1,960. When I go to C series and I multiply them by the probability, I get 3,450. Now, I am supposed to select the highest. The highest is 3,450. And which decision option do I have, or am I faced with? Is the C series. Is the C series. So quickly, I'll go in for the C series. Any question?
So what if there was no probability?
There will be probability. No question will leave you without a probability. Okay.
All right.
Yes. No question will leave you without a probability. So if it doesn't give you a probability, it gives you the market conditions, which looks like a probability, which you need to use them for that computation.
All right. Please, the question is it final exams or is a midterm?
Both. It's a both question. Okay.
Feelings, but
Feeling. It is one of the cheapest you can ever get.
wow.
I'm looking for one question to tell you. Okay. Okay. So look at a question like this. The question banks your madam can take a question from. So look at it. A company wishes to decide on a selling price for a new product. The weekly sales of each product would depend on the price charge and also on customers' response to the new product. The following payoff table has been prepared. Weekly demand in units. You see the probabilities, where the probabilities are. They are before the market conditions. And now we have price 1, price 2, price 3, price 4. These are the decision options that you're faced with. And then the question says that if the choice of selling price is based on the maximum decision rule, which price will be selected? If the choice of selling price is based on the maximum decision rule, which price would be selected? Is it price 1, price 2, price 3? So someone is asking a question. So here, they've already constructed it for you. 10,000, 8,000, 6,000. You select the
This is
minimum, which is 6,000, because it says maximum. 6,000 is the minimum. 9,000, 7,000, 5,000. 5,000 is the minimum. 4,000 is the minimum, and
right.
3,000 is the minimum. Which one will be the maximum of the minimums?
6,000.
6,000 will be the maximum of the minimum. And it's which price what?
Price 1.
So this one, have you thought deeply into anything? The information is just working. Then you are just supposed to do something simple. But there are more questions here, which I wish you can take a look at and then construct some payoff tables yourself. Last year I saw some payoff table here, which I walked them through. Same question. And then what did they ask? This is minimax. You see, a similar question. They're asking you minimax. So this is the maximums. This is the maximum under this level. This is the maximum under the level. And this is the maximum under the level. What is the minimum of the maximum? But this one is saying prepare a regret. So here, you don't need to just look at the minimax and then go away. So he's saying that prepare the maximum regrets. So first we are preparing the regrets what? Table. We are going to prepare the regrets table. So at each level, which one is the highest? At each level, what is the highest? So at the level of best option, this one becomes the highest. At the level of the most likely, this one becomes the highest. At the level of worst, this one becomes the highest. So it means that if you are preparing the regrets table, this becomes 0, this becomes 0, this becomes 0. Here will become 10,000 minus 9,000, which is 1,000. This one will become 8,000 minus 750, which is 500. I get to the picture.
Yeah. 1,000.
This will become 1,000. Hey, I'm even worse in the case. I'm looking for. So this will become 1,000. Here will become 2,000. This side becomes 1,000. This side becomes 2,000 again. This side becomes 3,000. Please, it's just the maximum value you have selected, less the payoff at that level. The maximum is 8,000 minus 6,000, which will give us 2,000. The maximum is 6,000 minus this, which will give us 3,000. After which, we'll be looking out for the maximum values. So the maximum under price 1 is 0. The maximum under price 2 is 1. The maximum under price 3 is 2. And the maximum under price 4 is 3. We are supposed to select the minimum. 0, 1, 2, 3. Which one is the minimum? 0.
0.
So which price will we go for? Price what?
Price 1.
It is not difficult. It will only be difficult for you if you decide to make it difficult for yourself. But then I love this question, this type of question. Here, they have changed the arrangement of it. They brought the market conditions here. And then they brought the decision options here. So this type of question will decide to confuse students because these are the market conditions. Already we were solving them like this, solving them like this, solving them like this. Now that they have turned the market condition, we also turn our question to this way. Peter, please ask your question. Is that a Peter who owes me some KFC and has been running away for a while now? Finally.
Oh, senior.
Finally, Mitra Pachibi.
Your destiny about time but is spoiled.
He said, "My KFC is full."
About time when I call you, I not get you.
Charlie, this is your gig there. Low key. I like that gig. Anyways, let's go on. Action.
I go meet you personally. Yeah.
My mind is
Are they around your area? So I go meet you.
My mind is in there. Make we go. Ask your question so that I proceed.
Okay, so first of all, let me take you to the criteria side.
Okay.
Is it possible for your first selection to be negative?
Of course, if there's a negative in that question, because it asks you for a minimum, and then if it says a minimum, if a negative figure is at that level, you can have a negative figure to be the minimum. But then the question,
Okay.
the information there is that if it is negative, you need to relate the negative to that
Mhm.
decision. It is not your concern. If it is a
Yeah.
negative value, you need to relate it to the decision. But then please, if you are drawing the regret
Right.
table, you don't bring the negative value. Because you are regretting doesn't mean that bring the negative value. For example, in a question like this, because the highest figure was 4,000, 3,600, don't go write 2,000 minus 2,400 minus 3,600 and say you regret 1,200 negative. No. Though you are regretting, yes, we have agreed that it is a regret table. So even if it is a positive figure, we know that you have lost that amount of money. So don't put it there. But then it's possible that the payoffs that have been presented to you, there'll be a negative in the payoff. Like the question that I am just displaying. When you look at the payoffs, this payoff, are you seeing a negative here?
Yeah.
So in terms
Mhm.
of selecting maybe the minimum, this will be the one I'll select. Because negative 5,000 is lesser than 50,000. It's lesser than 80,000. Please, do you agree with me?
Sure.
Right. Your
Definitely.
next question.
Yeah.
Your next question. I thought you have like 5 questions to ask. Your next question, please. Hello.
Yes. Okay. So, hello, can you hear me?
Yes, I can.
Hello.
Yes, I can hear you.
Okay. And then with the same regression, if the second selection, the figures are the same, if the values are the same,
Mhm.
is the selection does the selection means that substitute one?
Can someone help my gentleman for me? I think I want to get his question, but then I'm lost.
So I think he's saying that should we have the same values for maybe let's say like this example, like the best possible, most likely, and worst possible, all of them are of the same value. How are you going to go about with the selection?
Select the
I think
highest.
that
If there are 2 people in a class scoring 800, 800, they are both first, right?
mm,
We don't have the first and second because we need the best to be able to find the regrets. Without the best, you can't find the regret at that level. Can I be heard?
yeah.
Okay. So you select the best, that's all.
Okay.
The 89 will really be confusing, especially if you are doing the regret.
Yes,
I
yes.
wish we could rewrite it.
With this one I did right.
No, the number 89.
The 89. Oh, the 89 is not
Yeah.
asking you for regret. It's asking you based on a just simple idea. It says, what is the value of the company of obtaining this perfect market research information? Which is far away from finding a regret table. Okay. You are looking at a company wishes to go ahead with one of 2 mutually exclusive projects, but the profit outcome from each project will depend on the strength of the sales as follows. So, project 1 has strong demand of 80,000, 50,000, 5,000, and a strong, moderate, and then weak demand. And then project 2 has 60,000, 25,000, and 10,000 with a probability of 0.2, 0.4, and 0.4. The company could purchase market research information at a cost of 4,500. This would predict the demand condition with perfect accuracy. Now, what is the value to the company of obtaining this perfect market? This is expected monetary return. We need to use the expected value to decide this question. And you know how to use the expected value under project 1. 0.2 times 800, 0.4 times this, 0.5 times this. Then you come here, 0.2 times 6,000, 0.2 times 2,500, 0.4 times 10,000. You add up, and then you select the highest, less the cost, and you should get the final answer. We'll come back at all of these things. I want us to get the concept, and then once we pick about 20 questions under each topic in just one day, we solve all of them, and then we move forward. So decision making under uncertainty, this is where we want to end it. But then I want to explain this one in the payoff in your book, because that is what your lecturer would use in class, and then it might confuse you in the class. And that is another type of it, because some of the questions I've told you, you determine the payoffs yourself. And this is a clear example of determining the payoffs yourself. Okay, so let's read all together. Delish runs a kitchen that provides food for the various canteens throughout a large organization. A particular salad is sold to the canteen for 10 cedis and a cost of 8 cedis to prepare. Therefore, the profit per salad is 2 cedis based upon the past demand. It is expected that during the 250-day working year, the canteens will require the following daily quantities. So on day 25, they need 40 salads. On day 50, they need 50 salads. On day 10, they need 60 salads. On day 75, they need 70 salads. So we said that we use their days over the total days to determine the probability according to this question. So 25 out of 250 days, because they summed up all these days, 25 out of 250 tells you the probability at that level. 50, 250 will tell you the probability at that level. This over this tells you the probability at that level. And then 75 over 250 tells you the probability. And I've told you, when we learned probability at the early stage, we said that the sum of all the probabilities should not exceed 1. It should be between 0.1 to 1. It should be between 0 and 1. So it shouldn't exceed 1. So when you sum up all this probability and it's exceeding 1, then it means that you are going wrong with how to compute for the probability according to this question. Now, these are the demand for the salad, and these are what you'll be supplying for the salad. So we'll be using this to construct our payoff table. These are the demand and supply of the salad. But then, when you read on the question, it says that the kitchen must prepare the salad in batches of 10 meals. If its staff has asked you to help them decide how many salad it should supply for each day of the forthcoming year. So with this, look at how the payoff table is prepared. Supply and demand. Now, the question is that if you demand 40, it means that you are willing to pay 10 cedis. If I'm supplying it at 8 cedis. That is the cost at which I made the item. So the cost to prepare it is 80, but the cost to which you buy it is 10. So if it is like that, the thing is that you want 40. I have 40. I am preparing 40 at 8 cedis, and then I'll sell it to you at 10 cedis. Will I make a profit or not? Will I make a profit or not? What is 40 times 80? What is 40 times 8, which is 320? What is 40 times 10, which is what? 100. Now, I have sold it to you at 10 cedis. I prepared it at 8 cedis. I'll be making a profit of what?
2.
With respect to the quantity, okay. Let's go ahead. Let's do it this way. I think I need to rephrase the statement before it confuses you. You have ordered 40 pieces of items, and I am preparing it at a cost of 8. When I'm done preparing the 40 items, I'll incur a cost of what? 320. When I sell the whole 40 to you, I'll be making 400. How many profit or how much profit will I make?
80.
So do you get why we have 80 here?
Yeah.
Now, I have prepared 50 items at a cost of 50 items at a cost of 8 cedis, which is 400. You also need just 40, and I'm selling the 40 to you at 10 cedis. At the end of the day, I've already prepared the 50 items. Okay. And then you are buying just 40 out of it at 10 cedis. Am I making a profit or I'm not making a profit? I'm not making a profit. That is how come this place is 0. In other questions, they'll tell you what to use the extra 10 for. In another question, they'll tell you what to use the extra 10 for, and I'll show you a question like that. Then let's go to 60. I am making 60 salad at 8 cedis. 60 times 8 is 480. And I'm selling just 40 to you at 10 cedis. Will I be making a profit or a loss? I've already incurred the cost, and then you are telling me you just need 40 pieces, which I've already prepared the whole 60. And then you are telling me you want 40 pieces. Will I make a profit or a loss?
Loss.
A loss of what?
80.
That is why it is in brackets. Do you get it?
Yeah.
Who's lost? For the supply there, that is what I have prepared though. But your demand is lesser than my supply. I've already prepared the item. So just like I have already registered for the Zoom more than 1 hour. And whether I get 20 students or I don't get 20 students, I've already registered for the Zoom.
Mhm.
So if I've already registered for the Zoom and only 10 people patronize me, and then I pay for the Zoom, I paid for it for like say 100 cedis, and 20 people patronize me, and then they still pay 20 cedis per person. I am making 20%, 20 cedis per person, and I have 20 people. That is about 400 cedis. I've paid 100 cedis. I'll make profit. If 2 people join, I've already paid for the 100 cedis. 2 people have joined. That is 40 cedis. I'll still make no profit. I'll rather be losing the 600. So for the cost you have already incurred on all the items you want to supply. But then the demand is lesser than your supply. But the demand, you are selling it to them at 10 cedis. But when you were preparing the salad, you prepared it at 8 cedis on the total salad you have prepared. And then here lies the case that the demand for that salad is less. So you'll be losing some money. And that is how come they have negative. So assuming it is 70, I prepared the whole 70 salad. And I have incurred a cost of about 560. And then you are telling me you just need 40. Who should take the remaining 30 pieces? Who should come and take it? Since I don't have anyone picking the 30 pieces, will I be making a profit or a loss? Will I be making a profit or a loss? I
A
prepared
loss.
70. You have come for 40.
Waboka.
You should come for the 30. So I'll be making a loss of about what? 160.
Waboka.
Waboka. So you
So
come.
it's always supply minus demand.
It is always surplus. That is what?
It's always supply minus demand.
Yes, the supply minus the demand.
Okay.
And then with this question, they didn't tell us excess supply will be matched against something. Let me see if I can get this question where they told us that the supply in excess must be used for something else. These people's assignments, would I even find it? Assignments. Okay. I'm praying it opens for me. This is the solution. A minute, please. Okay. So let's go ahead before it opens. Not, yeah, discuss maybe. Same thing. You want 50. I prepared 40. I don't care where you get the extra 10. But then the 50 that you want, you are paying 10 cedis on the 50. But then, would you be paying for the whole 50? No, because I can only supply you my limit. Do you get it? I can only supply you what I am. You have. I have. I can't supply you in excess. So here, I can only supply you the quantity I have. That is why it is still going to be 40 times the 10, and then I am making 40 times the 8. So here still remains 320. Here still remains 400. Okay. I have sold items to you, the 40 items to you. I can't supply your excess. So you are making a revenue of what, 400, and then I incur the cost of just 320. So I'll be making a profit of 80. That is this profit. The next question is that you said you are making 50. I can supply 50. You want 50. Yes, indeed, I can supply the whole 50 that you want. So here the quantity changes to 50 and 50. So here it changes. It is only with this part, the first part, that gives you the bit of headache. So look at it again. 50 times 80 is 400. And then you made a revenue of 500. Are you making a profit or a loss? You were able to sell the whole 50 to them. Are you making a profit or a loss?
Profit.
Profit.
Now, they want 50. You have already made your 60. So for yes, you'll be incurring a loss on it. So that one there, you have made your 60 pieces, and the 60 pieces is 480. But then you gain 500 from the 50 pieces, meaning that you'll be making a profit of what? 20.
Thank you.
That is the concept. You can do the last one, the 70, and confirm. Let's come to this one. You want 50, you want 60 salad. I can only give you 40. So it goes back to the first knowledge. 40 to 40. I can't supply more than the 40 I have. So it's still back to 40, 40. Okay. 8 and 10. And I'll make a profit. Let's go to the next one. You said you want 60. I can only do 50. So it is going to go to 50, 50. Because I cannot supply your demand, full demand. So it is still going to give me what? The same 100 that I have here. Same thing when I come to supply of 60, 70. You want 70, I can only do 40. So I do 40 against 40, and that will tell me my profit. I'll do 50 against 50, and it'll give me my profit. When it comes to 70, I'll do 60 against 60 because I can't supply the whole demand of 70. So it's going to be 60 to 60, and that will give me a profit of 120. So you can test it with the formulas. So it is this column. It is this column, this column, this column. That tends to confuse. And then under the next column, this column, this column, this column. That will help you get more confused with respect to this particular one. Then the expected values, like we know, is just the payoffs you have determined multiplied by their respective. So 0.8 times this, for 40 salad, 80 times 0.2, 80 times 0.4, 80 times 0.3, and we'll give you for 40 salads. So you can see it. So let's go to the question I wanted to show you. This one, your lecturer will sort you out in class. Oh, I thought I have their question. Ah, I wanted the assignment question for you. Good. Good. So this is the question. It says that you own a pizza shop in Kumasi Mall. It is Saturday morning, and you are trying to decide how many pizzas to make to meet the demand, to meet today's lunch hour demand. Based upon your experience with the Saturday market, you think that the probability of being able to sell 20 pizzas is 0.2, being able to sell 40 pizza is 0.3, and then being able to sell 50 pizzas is 0.5. Now, suppose a pizza sells for 10 cedis and has an incremental cost of 4.25. If you have leftovers pizzas, you can sell them to the homeless shelter for 1.25 each. If demand exceeds the number of pizzas you have prepared, every disappointed customer costs you 0.2 worth of loss of goodwill. Define the decisions, alternative, state of nature outcomes, revenue, cost, and the payoff for this problem. Then construct the payoff table. What is the decision-making situation based on your knowledge about the state of nature? Assume you did not have the probability knowledge. Identify the decision you would make using each of the following criteria: the maximax, the maximum, and then the Laplace. You guys will not need a Laplace. The Laplace is meant for management science students and then logistics students. So this is a logistic student, the logistics and management students, assignments that was given to them last semester. Whilst you guys are not doing it, they did it in level 300. Then the next one says that find the expected monetary value for each alternative based upon the EMV criterion. What is the best decision? Draw the decision tree that the problem calls forth and solve it. Okay, so now this question, you need to determine the probability. See, they are telling you that you are going to supply 40, 20, 20, 40, 50. So this becomes the demand and the supply. The supply becomes the decisions, the alternative decisions that you have, and then the demand becomes your state of nature, the market condition. So if the demand becomes your state of nature, and then this one becomes the decision option, there is a question that you need to think about. If I prepare 40 pizza and the supply is, if the demand is 40 and the supply is 40, it means that you don't need to include any of these things. So you look at the formula that was propounded according to this type of question. So look at it. The payoff is the revenue from the pizza sold plus the revenue from the leftovers, if any, less the cost of the pizzas made minus the loss of goodwill. Now, how do I mean by this? You want 20 pizza, and then you can supply 20 pizza. This question says that 20 times how much is the revenue? The revenue is 10 cedis. 20 times 10 cedis will give you the revenue for the pizza. Are there any leftovers? No, because you demanded 20, you supply the whole 20. You demanded 20, you supply the whole 20. My demand was 20, my supply is 20. So there will be no revenue from leftovers. Now, the cost for making 20 pizza, that is the supply. The cost for making 20 pizza will be what? 4.2 times 20. Then the lost, there were no lost on it. So it is going to be just the revenue plus the cost. There were no loss or gain under 20 to 20. But look at 40 to 20. They demanded 40. You said you can supply 20. You lose 20 customers. And then the question says that anytime you lose 20 customers, what should happen? Anytime you lose customers, if your demand exceeds the number of pieces you have prepared, every disappointed customer costs you 0.25, meaning that the excess of the 20 would give you a lost demand, which must be less from it. That would be the excess 20 times the excess of the 0.25. You have no leftovers. You can only have leftovers coming in anytime supply exceeds demand. So that is the nature of how another question can be propounded for you to go and solve. So it is an interesting topic. It can beat you, you can beat it. But at the accounting level, this one will not be giving you to go and prepare. Your form of demand for the payoff table will be just an ordinary profit or loss. So you can actually see, I'll give you the video recordings for this so that I will not take much of your time. And then you'd actually go around it and see how best you can help yourself. But this payoff table, just like I read here, you should understand how to compute for the expected values. Now, expected values, like I said, is prepared according to the state of nature. Supply is always the options. Supply is the decision options that you have. And then the demand is the markets. The demands are always the market conditions. The supplies are the decision options, and then the decision alternative. So you see me writing decision and then state of nature. State of nature means the market conditions. Take a deep breath and then read. You understand it. In a situation that is blah, 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 blah. So in a question like this, let me clean everything that I've done or circled in it. After determining the payoff, if they ask you to do the maximax, can you do the maximax? This is the payoff that we have all determined together. So assuming we have been asked to do the maximax, assuming we've been asked to do the maximax from this table, what will be the maximax from this table? It means that we need to go according to the alternative. So under the alternative 40, what is the maximum value? 80. Under alternative 50, the maximum value is 100. Under alternative 60, the maximum value is 120. Under alternative 70 is 140. Now, what is the maximum of all these maximum values?
140.
140. Are we sorted? So 140 goes for what salad? The supply of what? 70 salad. Please don't just focus on the figure, but trace it to its alternative decision. So the supply of how many salads?
So, Mr. Bernard,
Mr. Peter. What's Mr.
in
Bernard?
this case,
What's Mr. Bernard?
in this case, let's say our maximum figures are 140, 140, 140, 140. Which option are you going to choose?
Write all the options that are available. Are you telling me that I have 140 here, 140 here, 140 here, 140 here? Then tell me that I should supply both 40 salad, 50 salad, 60 salad, and 70 salad. Which the question will not give you that. There will always be a fluctuation. There can be two decisions to take. Fine, you can select, but then I've not seen one before. Ever since I started solving questions like this, I have never set eyes on a question like that before, whereby they are all the same. Except you have seen one and you want to share with me.
I will share with you.
So all of then what statistics and the So okay, I quite with you. So what I'm just trying to say is that you can play around this one using the 3 criteria. So here you can even prepare the minimax regret table by looking at each state of nature. So the best figure here would have been 80. The best figure at the 50 salads would have been 100. The best under the 60 would have been 120. Then the best here would have been 140. So when I pick 80 minus 80, I have 0. 80 minus 0, I have 80. Minus 80 minus 80 will give me minus 160. So I'll be regretting more. This one too, I'll be regretting more. So it goes on and on and on and on. Here will be 100. I regret 20, 0. I regret 80. Here I'll be regretting 160. So attempt it and don't sit idle and share your possible answers so that we'll talk from there. On this note, if there are no questions, my empon, I want to introduce budget. So I'm breaking this record if you don't have a question.
Mr. Bernard, you said that question is not for
Hey.
accounting students.
Which one?
The one that we looked at before.
This one. This one.
Yeah.
Oh, no. This one is not for accounting students. It's for management science students and then logistics students. Oh, but you can play around it. I have a video recording on it already, which I can share with you, and then I'll share the questions too and the solutions so that you play around it for learning.
Sure.
For academic purpose, so that you understand the concept deeper. Okay.
All right.
Asan. So examinably, I've shown you how the exam question for payoff looks like. So don't sit idle on it. If I find more questions on that, I'll share with you so that you know. But then once you understand the concept and appreciate it and understand who a risk averse is, who a risk seeking person is, the risk averse, we said, is the pessimism. And the pessimism, it will be looking at the minimax and then the maximum. And then we'll come to a risk-seeking person who will be looking at either the minimum or the maximax. Then we'll come to the risk neutral, which will be looking at the EVs, the expected values, or the EMVs, which is the expected monetary values, by multiplying the probability by the payoff at that level and summing them up together to select the highest, which is the risk neutral. With the minimax regret approach, we first determine the regret approach by looking out at each state of nature level, select the best as the alternative and use that to prepare the regret table. After you prepare the regret table with that, then you now focus on the maxi under each decision. Then from the maximums under each decision, you select the minimum. On this note, I know there are no questions.